investor priorities, key drivers in tourism investment. Will explore the factors that influence where and how investments are made in the tourism sector. This panel will provide a deep dive into the perspectives of global leaders shaping the future of tourism investments, addressing critical drivers, opportunities, and challenges. Moderating this session is Ömer İsvan, President of Servotel. Mr. İsvan, welcome to the stage. Thank you for joining. Diane, Daudin, Clavaud, Corporate Director of Global Business Development. Hello, hi.
How are you?
Thank you very much. How are you? Alper, Önder, Global CFO, Doğuş Hospitality and Retail Group. Hoş geldiniz efendim. Hoş geldiniz. Buyurunuz. Saurabh, Chawla, Vice President, Transactions, Westmont Hospitality Group. Merhabalar, hoş geldiniz. Welcome. Marina, Carillo, Amengual, Development Director, Melia Group. Hello, how are you? It's a pleasure, thank you. Ve son olarak Amin, Ismail, Managing Director.
Certares.
Hoş geldiniz. Hi, how are you?
Good, how are you?
Buyurun.
Thank you.
Sizde söz, buyurunuz.
Yes.
Yep. Okay.
Herkese merhabalar. Bu paneli İngilizce götüreceğiz misafirlerimizden dolayı. Öncelikle bir küçük tanıştırmadan sonra panelimize başlayalım. Welcome all of you. Nice to see you here. Nice to see you with us. I just want to have a very quick round of introduction as to who you are, what your company does, and then approximately 42 seconds each. And then we'll shoot off. I'll start with you, Amin.
Amin Ismail, Managing Director. Certares is a private equity fund focused on investing in travel and tourism. We own businesses that you're probably aware of. American Express Global Business Travel being one of the first transactions that we did. We also own a company called Hertz, which I'm sure a lot of you guys are familiar with. We're an investor in TripAdvisor and own a group of leisure tourism businesses in the U.S., a company called Internova. Voyager de Monde is a business that we're invested in France, as well as Marriott, among some other names that we own.
Yeah, so. It's quite a specialist investment group, and not many of you guys around in terms of the supply line of tourism.
True.
Good to see you, Alper. Let's
Thank you.
Continue with you.
Hello, I'm Alper Önder. I am the board member and CFO of Doğuş Hospitality and Retail Group. When we talk about Doğuş Hospitality and Retail, we're talking about restaurant business, retail business, and tourism business. Tourism business is composed
entertainment
of hotel,
as well.
entertainment as well, under restaurant business. And under hotel, tourism business is composed of hotel and tourism agency, and most part of tourism business is composed of hotels. Thank you.
Ömer İsvan, I'm the founder and president of Servotel. We're a global advisor on hotel investments, and our life is of 39 years over about 45 countries. Currently, we're on about 18 countries. And most of our work is greenfield, but we do work with brownfield and also midstream acquisitions and turnarounds and things like that. So it's an advisory business. So let's continue with you.
So, hi everyone. Thank you for the kind invitation. I'm Diane Clavaud. I lead the development worldwide for Nobu Hospitality. So, as many of you know, we started 30 years ago as a restaurant brand, placed in iconic hotels. And we have evolved to a hotel chain and a branded residences chain as well. So we have around 60 plus restaurants, 50 hotels, and 15 branded residences so far. So we operate globally on 38 countries, 6 continents. So basically, yeah, operating hotels.
Excellent. Saurabh.
Hello, everyone. I'm Saurabh. I represent Westmont. For those who don't know Westmont, we're one of the largest owner-operator of hotels. We've got about 200 hotels spread across North America, Europe, Africa, and Asia. We're a value-add hotel investor, and we invest actively into hotels. Lovely to be here.
Yeah, Marina.
Merhaba, everybody. A pleasure to be here. My name is Marina Carillo, and I'm responsible of the development in Melia Group. Melia is listed in the stock exchange market in Madrid, hotel company with more than 400 hotels in 43 countries. And one of the things that I would say specializes the most is we're focused in leisure, in resorts and leisure markets when it comes to cities. And yeah, now we're present in 45 countries, I was saying, and happy to step into Turkey also very soon.
Thank you. Just to set the scene and in terms of defining terms, the panel name is Tourism Investments. I personally have an issue with handling tourism as a single entity because tourism is really not a sector nor an industry. Tourism is a phenomenon, and it's a composite of various industries, and it just doesn't work without each other. Fortunately or unfortunately, most of us here are, other than you, very hotel-oriented, and with the exception of Doğuş, which has a cross-industry exposure in terms of restaurants and entertainment and retail, which is going to become more and more relevant as we go along in terms of trends. But just excuse us that a lot of this conversation is going to be a little bit around hotels and resorts rather than other components of tourism, other than the supply line as you seem to be investing in serial terms. Why don't we start with you? Because you're the odd one out here. That
we do have a hotel fund, and it's actually one of our top-performing funds. So not an advertisement, but it is a property fund that only invests in North
that's
America.
real estate.
Yeah.
Real estate and property.
Yeah.
But not too many hotels there, right? I mean, is there hotels in the real estate fund?
Yeah, we just launched the fund in 22, and I think we're up to 15 hotels.
15 now?
And we're on our second fund now, and it's, again, top quartile. So I think we're doing pretty good for a private equity fund investing in hotels, so yeah.
But tell me more about the cyclical behavior of the supply line in terms of the travel business rather than the supply side on the hotel side.
Listen, it's a very important. I disagree that it's not a sector and an industry because you're right. It touches a lot of things. It touches the airlines, it touches automotive with the car rentals, and then obviously distribution, travel could be hotels and
right.
other assets. But it does not get any tougher than what we experienced during COVID, for example, in terms of the disruption to the business it had, to our investments, as well as I'm sure all of your investments.
No,
in this
everybody
space.
was affected, but I mean, you would have been affected. I mean, enormously. And how did you survive? Honestly,
we survived because I would like to say that we buy them right. We did not have anything in our portfolio that was impaired. I think a lot of it has to do with how judicious we are with how we utilize leverage. We were talking earlier. We tend to use less leverage in our transactions, and we tend to buy them right. We identify value. And we appropriately price and leverage the businesses when we invest.
I guess low leverage is one thing, but when there's no travel in the travel business, I think
some
it's
of our
pretty
businesses
challenging.
went down. Some of our businesses, our corporate travel businesses, as an example. So we owned a business in Abu Dhabi. Their business disappeared in March of 2020, literally overnight, by 95%. But it had a strong balance sheet. It was able to withstand. Obviously, they took some measures with our help and advice. They were able to weather the storm and deal with it and that same applies to Amex GBT, Internova, again, the largest ledger business in North America, similarly was affected. And it's I think it's a combination of, cutting costs at the right time and knowing where to invest in and how to invest in it. So,
Right.
yeah.
Alper, let's go with you. In terms of investor priorities, I want to focus a little bit on the property side, on the hotel property side, and you're spread around a few countries, and includes Turkey. But what do you look for? What are the key priorities for you in terms of looking at an opportunity? I always distinguish between opportunity and something for sale. They're two different things. When do you call something an opportunity versus something for sale? And what are the key drivers that you look at?
Actually, now, as I said, we are concentrated in our sector under three sub-segments: restaurants, retail, and hotel. In the hotel business, before we invest, we have in the restaurant business, first of all, and retail business, if you invest, you have to think twice. But if you come up to hotels, you have to think significantly more than twice because of two major facts. First of all, the capex in the hotel business is significantly higher than retail and restaurant business. Secondly, the payback period, or ROI, or return on investment, is significantly longer than restaurant and retail business in hotel business. Therefore, we are very careful in investing in hotel business. What we are looking for is mainly, the main drivers are, we try to predict the market demand in coming 2 decades, 10 to 20 years, if we invest in a hotel, because of the fact that the payback period is already longer. And if we tick this box, and if we believe that there is a potential in coming 10 to 20 years in the territory that we are looking for, in the territory that we are planning to invest, the second part that we are looking for is the municipality in this region, plus the government, and plus the people living there. Their attitude towards tourism, their attitude towards at least infrastructural investments by the government done in those regions. And of course, the view of municipality is very important for us, whether they would like to attract tourism there or not, whether they would like to see the potential there or to seize the potential there, etc. And if we tick this box, then it comes up to the economics, of course. How big should this hotel be? What's the occupation rate? What's the ADR that we should be in coming years? We should have in coming years. And of course, then it comes to the economy of typical cash flows. What you invest, when to get back the investment. These are the 3-4 main items that we look at as everybody looks, actually.
And in terms of financeability and leverage,
yes,
is that do you look at destinations where it's easier to borrow, or lower cost of borrowing?
Definitely. After we tick the box of this economics, then we come up the leverage side, the borrowing side. We are not investing neither by 100% borrowing nor by 100% capital. So we have an imbalance in between. The ratio of balance depends on location and the case, and the availability of the funds in the proper prices.
If I let you completely free, and in terms of choosing jurisdictions where to invest, where would you be looking for opportunities mostly?
As Doğuş Group in last decade,
it was opportunistic. It was opportunistic.
Yeah.
I mean, I'm not asking about history.
No, not
I'm talking about...
we made many acquisitions and exits in last decade, actually. And if we come up in 2 days' time, I think Turkey would be one of the best destinations for us to look at the further investments together with Croatia. We are now building a hotel in Croatia, for example, in Zadar, in Croatia. And on top of
you
this,
already had something in the history there.
Yes, we have exited on this. Now we are building a Hyatt Regency hotel in Zadar, and Spain is one of our destinations in radar. Those three are important for us, and of course we are looking at Middle East for the time being, Dubai, Qatar, Saudi. We are just investigating them for the time being.
Dan, in terms of your asset light, I mean, you're not necessarily looking to invest, but I'd like to flip the card a little bit there on your perception of how your investors' priorities are and what they're looking for, and then, of course, how your strategies will gel into their strategies. When you're selecting a location or selecting yes or no or assessing the viability of a project. But what do you see in the investor's motivation these days?
So, so far you're right. So we asset light in Europe, and we asset free in Europe and asset light in US. We do own some of our hotel in US. What I will say is that the usual for us, like so far, we have still 7 billion really invested in real estate through our partners. So it's not nothing. And what we look at is usually where, so there's 3 observations: where our customer wants to go, where our investor wants to go in terms of destination, and where they always look at where our food and beverage will work first, and then the hotel. Because let's not forget, we're upside down. We take the equation a little bit upside down. For us, we need a very, very high traffic in our food and beverage. And then it appears that we do have rooms on the top or branded residences now on the site. So it would be, I mean, I could be offered a beautiful property in the middle of the Tuscany, in the middle of nowhere. It might not be for a Nobu because I do need a traffic in my restaurant, and we usually do and we usually do 5 turnovers. So the thing is, so far the equation that we have is that in a day you would do as much as you do in a seat of a restaurant that you would do in the room. So this is important for us. So it changed a little bit the strategy of where we will invest. Also, in terms of investment, we only work with, we mainly work with, sorry guys, but with high net worth individuals. So that's also a very, very different strategy of investing. Private equity will invest differently than a high net worth individual who just want to own a hotel and an asset wherever in a city or resort.
What proportion of that, given that it is kind of more individualistic or private equity, touching you, what proportion of the motivation is trophy and what motivation is hardline mathematics in your investors' approach?
I would say that first it's the asset and the value that the asset will take, and also the location, that's for sure. I don't think we only have trophy. Like, I mean, Portman Square is definitely a trophy in Mayfair, but Shoreditch, where we started, was not an evident. No one was there. We were the first one, and everyone were like discussing.
I think Ace was there, I think, or right, like at the same time.
But we didn't have, I think, our lifestyle or luxury or relaxed brands like Soho, and everyone started to come after. So sometimes we do choice in a little bit of a different way because we believe in one area, or also actually it is about the assets, but it's definitely about the ownership for us. Because you have also to remind yourself that it's very different than a different chain in the world, because we are basically working like a family office. It's a private company. It's one chef, one actor, one businessman. So there is a very passionate side to the way we do things. So it's first a partnership between the owner and our shareholders as well. Some of our owners own 6 or 5 Nobus in the world. So it has to be a relationship first, and then a decision on the asset, on basically expanding the brand.
Right. Saurabh, we go a long way, huh? A long way back. So I want to ask you, in terms of your approach, you're slightly shy of greenfield and taking development risk. I want to ask why, because yes, it is true that acquisition at the right price at the right opportunity is probably many times below replacement value. Yes, I understand. But in certain areas, we see opportunities much higher in creating value versus acquiring value. Is there a dynamic getting an increased appetite on development, or would you be a hard line looking for below replacement value acquisitions?
So in hotel investments, Omar, there are three kinds of risk. There's a development risk, there's an operating risk, and there's an exit risk. Now, to create value, we are comfortable taking a certain amount of development risk, so repositioning, repurposing assets. But when it comes to greenfield, it's a completely different level of development risk, which we don't have the competency of taking. But that said, and actually very recently, we've actually ventured into a greenfield development project in Spain, and largely because we partnered with a blue chip developer, Grupo LAR, in this case. So first, to overcome or mitigate that development risk. But the second aspect is also what we've seen in Spain particularly is that the cost-based development is far cheaper than the yield-based returns. So in other words, you're building a room for, I don't know, 120, 130,000 a key, but you're selling it at 200,000 a key. So there's an immediate value to that. And we wanted to take advantage of that. But that's probably as far as we've gone in terms of greenfield development. There have been a couple of other cases where we've helped banks to take over developments where developers had gone bust, and we built it. But yeah, as a proactive approach, we restrict ourselves to that unless the market nurtures to it.
Okay. Marina, you're a mixed bag. I mean, you own and you operate, right? And but more operate as you expand.
Mm-hmm.
You're not in the big acquisition radar, as far as I know. And in terms of the same question as I asked, and in terms of what you see in investor motivation and in investor key drivers, and how your strategy of expansion meet. Where do those two things meet, and what do you see as the key drivers and motivation of your investors?
Well, initially, as I said, we were strongly focused on resorts. So 5 years back, it was a little bit of a niche investment. Not everybody was ready to invest in resorts. But I think since the pandemic, this transformed completely. The market evolved in a way that it get to a point that is even more interesting to invest in resorts than traditional cities, where there is more stability, but maybe the ARR is a little bit lower. So now we find these destinations. You don't have maybe traditional investments or investors, but we need to introduce these destinations, these resort areas to the investors. So we have some key elements that we need to find in these destinations. For example, connectivity is key. The surroundings in a city is very obvious. Of course, in Istanbul, you have everything. In London, in Paris, it's very obvious. But when you go to resorts, the complementary offer that the destination has, we see now a lot of guests looking for experiences more than the hotel itself. So where is the hotel located? What can they do? Can we stay there for 5 days or 7 days? Can we stay there all year round? So I think connectivity, occupancy all year round, that helps a lot. And also investors, resorts development are a little bit tougher, I would say, than in the cities. So the expectations on timings are a little bit complicated, but we work on different levels. For example, in Melia is growing a lot in Albania, where 18 hotels are being developed under our brands. So that means there's going to be a mid-term, long-term vision for the country. However, in other destinations, where in Greece or even Turkey, where the existing hospitality inventory is already extant and of quality, that would take us to a more quick redevelopment. But in both cases, we're finding investors focusing on this.
So you find rebranding easier job than greenfield as well?
At the end, quicker fees, right? It is the basic mathematics. The quicker you can open, the less risk you can have in the meantime. We had a hotel, for example, in Rome, and it took us 10 years to open, because every time you dig a hole, they find something. So you need to stop. So of course, redevelopments are much better for investors in general, but still we have a lot of opportunities of a higher yield in the right development. But you need to find, as they were saying, the right partner for the development.
And in terms of equity participation, what are the limits, or what are the typical scenarios where investors say, okay, brand yes, operator yes, skill set in terms of distribution yes, but hey, listen, if it's a marriage for such a long time, why don't you put some skin in the game? What is your approach to that?
Well, 15% of our total portfolio is owned. And then maybe 10% more will be joint ventures. Even we work a lot on leases too. So we are used to offer skin in the game. There is a need sometimes because of the financials of the project, but sometimes it's just a matter of showing some commitments. Initially, it's more of an asset-light strategy of the company, but in some cases, even a 5 or 10% of co-investment it is requested, and we're happy to jump if the partner is right.
That'll put you in a good position in this country, at least, I'm sure. Saurabh, I'm going this way right now. I have a question for you. In terms of doing a pro forma, looking forward into an investment, yes, there's the investment side of it, there's debt servicing, there's an operations that produce an EBITDA, and that all gives you a net cash flow, and then you have an exit point. Where do you factor real estate asset appreciation that happens in that jurisdiction, in the bricks and mortar, rather than the appreciation necessarily of the operating result? Because ultimately, all pro formas have a stabilized, inflation-adjusted straight line after a while, if you're looking at a 20-year perspective. But somewhere along there is brick and mortar appreciation. How do you factor that in?
That's a very good question, Omar. And the honest answer is we don't. There are certain markets where asset appreciation is so significant, but the yields or the cash flows you get are quite small. And we struggle to underwrite acquisitions in such market. I think sometimes we take a view of a cap rate compression, but that's really as far as we go towards factoring a little bit of appreciation. But again, there isn't a science to factor capital appreciation. It's really what has been going as a trend more than anything else. So we find it very hard to underwrite capital.
That's why I asked you. I mean, it's there's not an exact science. We're working very hard on that to incorporate that somewhere into the cap rate. As we were talking earlier on, you were saying it's inbuilt into the cap rate somehow, into the exit rate. But there's no science. But there is a fact, because we've seen situations where the EBITDA multiplier, if you kept it constant, actually the brick and mortar outperforms it. We haven't seen the reverse, luckily, other than wars and sort of force majeure type of environments.
And you're right, because we need to adjust the models. The science is widely used in Europe and US, where it adheres to the yield-based / cap rate type of investments, whereas markets in Middle East or here as well, it's you need to adjust maybe a combination of DCF with replacement costs. I don't know the answer to that.
We have some answers.
But, yeah.
We have some answers, but I know that it is an overlooked subject. It is somewhat put under the carpet and either built into exit rates or ignored. Where it shouldn't be ignored, because it could be a significant factor in assessing an investment. In terms of your investors' expectations of IRR, of course, jurisdiction to jurisdiction and country risk versus country risk may be different, but where do you see the return expectations when your investors get into a greenfield or brownfield, creating a Nobu?
So usually I think so first they believe in the brand, and we usually have a ROI which is between 2 and 3 years, depending on the city, and I think they see a value as well on the assets especially on greenfield. For example, if I take an example of Portman Square in London, which was another brand before, and now I think Ian Livingstone is quite happy with it.
By the way, how did that do? I mean, how did that interact with Shoreditch?
It's two different owners.
Did they? I know, but how?
Yeah, we have so on operation. If you mean this, so on operation.
In terms
so
of market division.
On ownership, not at all, but on operation, we do have, of course, cross sales. It's two different owners, but we have a synergy. But honestly, I will be very frank with you, it's two different segments. I would say that if I would take the Middle East as a segment, for example, I would say that maybe the father and the mother are going to Portman Square, and the kids are going to Shoreditch because they don't want to see Mama and Baba. But if I just take an example, and then maybe they're going to Portman Square at one point, but they're like, you know what, I want to be with a cool kid in Shoreditch. So we have this, I think that the synergy we have with Nobu is like you go from a ryokan in Malibu, which is like 12 bedroom, to Toronto, where we just opened a 650 branded residences
very boutique, yes.
and hotel. And it's only 50 suites for the hotel and actually 600 branded residences that were gone in 3 months. So I think that's the scope with us. It's like we're very flexible, on what we can do. We're a private company. We have no debt. We have been in the market for 30 years.
Talking about, sorry, I interrupted that. But talking about flexibility, tell me quickly about your model where you're a hotel within a hotel, like in Vegas, like in Atlantic City. Like in Puente Romano, for example. That's hotel within a hotel. It's some sort of a marriage or flirtation, whatever you want to call it. What kind of a relationship?
It's like an HM mixed with a franchise. So basically the way we work, so 95% in the world we're on HMA, pure HMA. But it's true that some of the Nobu, especially in the US, sorry, is it me?
I don't know.
Yeah. So some of our Nobus are I would say licensed in a way. So let's take Puente Romano with Daniel Chamoun. So it appears that Daniel has a lot of hotel already in the world. He's already familiar with the brand. So what we do is we are basically the front of the house. We manage, we operate, but the only difference with the other Nobu is that he will keep the back of the house because he have also few Nobus. So on Ibiza or Puente Romano, he will keep basically the back of the house and the administration, the accounting, and we will be the front of the house. But it's mostly managed. He will have also maybe two of these guys or GM that will also be overseeing. But it's really a marriage. So it works a little bit the same way, but it's just there's more license to it than only pure HMA.
There are no two HMAs in the market then. It's one is an owner, one is an operator.
Yeah, so. And we really mailed down. For example, you mentioned Puente Romano, so we're actually extending. So we're taking over.
You're taking more and more?
Yes, yeah. We're taking every year. We are adding like 10 suites. So I think at one point we might extend even until the end. But and we do bring also the brand. I mean, I can mention Cipriani. I mean, it was actually Nobu who introduced Cipriani in Puente Romano. So we actually also do try to create and help our owner to create this destination place. That's the usual the way it works.
Alper, we're in Turkey, and a lot of the investments in Turkey are underlying land assets which are not freehold, and they are leasehold. Whether, like in Galata Port, you started with 29, now you're at 49, or many times if you're doing an acquisition, you're looking at a remaining lease term of 25, 30, whatever it is. How do you differentiate between the two in terms of return expectations?
Actually, geliyor mu sesim? Şu anda? Bilmiyorum.
Okay.
Geliyor mu şimdi?
Evet.
Okay, thank you. Actually, as you said, there are mainly three ways of acquisition of any hotel brand. First of all, you rent the land for a term, or you get it from concession through a concession agreement for a longer term from government, or you acquire the asset. Of course, during our valuations, all those three differences will change the assessment of us. And if we own the asset, the multiplier in the future will be significantly higher. If you go there...
more technically, what do you think between a 49-year and a freehold? Where would the delta be?
It will be by 3 or 4 times. In the multiplier differ by 3 or 4 times. So if you own it, it will be between 15 and 20. If you don't own it, between 12 and 15,
yeah.
like that.
Mm-hmm. Right.
It will be like that. In general, of course, it depends on many instances, but at the end of the day, it's like that always. And based on your question, whether to separate the value of the asset from the operation, it's, to my experience, almost not easy or almost impossible to make this distinction in many cases.
Yes.
That's why the EBITDA multiplier is higher than restaurants and
because
retail.
it's freehold. Oh, it'll have an inbuilt appreciation. I mean, unfortunately, we have to cut it short for various reasons. Okay. But I want to give you a snippet about how you're looking at Turkey in terms of a investment grade destination.
Sure.
In terms of its geopolitics, in terms of its macroeconomics, and in terms of its governance.
Sure, sure. Maybe I'll take it a little bit differently. I'll tell you about the themes that we're focused on right now. So we think there has been a shift in consumer behavior, and people are looking for more experiences than material things, and so we think things like adventure tourism is big, and it's certainly these are the types of businesses that we're looking for. Really focused on, and we'll probably make an investment in the near term, and I see Turkey potentially being one of these markets, is wellness and longevity, and that's been an area that we're very focused on. That will also probably have a hospitality component to it. We're out there looking at opportunities in that space, but generally speaking, in anything that we invest in, we look for category winners and good partners. For Turkey, it would have to be a good local partner that we would partner on if we find the right opportunity.
But generally asset light, right?
Generally asset light on the private equity side.
On the
longevity and wellness is going to by default have a hospitality asset component.
And bring some more to there.
Yep.
Unfortunately, we need to give it to a close. Anybody wants to say any last minute things? It was great to have you here.
Thank you.
And thank you for listening, and hope to have a successful rest of the summit, and hope to see you all soon.
All right.
Thank you.
Thank you.
Thank you.
Very much for your participation in this for this wonderful panel, dear panelists and our moderator.